So the other day at school, we were sort of talking about current events, and someone mentioned the stock market and GameStop.
Oh, okay. So y'all were talking about the spike in GameStop stock and the short squeeze. Do you know what any of that is?
I think I might sort of get what it is.
Okay, so like you know how the stock market goes up and down, right?
Yeah,
All right. So well, let's look at GameStop. You know what GameStop does, right?
yeah, they sell video games and stuff like you can rent them.
All right. So of course we use the cash tag here to search for the GameStop symbol. It's very popular right now. And so, do you think that people buy a lot of games in person now, or do you think they mostly just download them?
They probably just download them.
That's right. So, GameStop's model was part selling games and part selling used games. Now, look at this. This is for a year, a calendar year. See, this line is super low. And that's because most people have identified the fact that GameStop's business model is a little bit out of date because most people aren't purchasing physical discs anymore, right? They're getting their stuff through digital downloads. And so that means that there's less traffic at the GameStop stores. They also used to do um, what you would call used games, and um, they would go in and you could take your games that you'd used and you could sell them, and then people could go in and they could buy used games for cheap. And so,
Kind of like a used car.
a little bit like a used car. But since people are doing most of their stuff digitally, like this business model has kind of run out. So if you think about like the games that we've got on our Switch, like very maybe about 50-50, and we're probably in the sort of on the minority on that. We probably have a lot more games in actual physical cards than most people, and even the ones that we have in cards, they have what's called DLC, downloadable content,
Oh yeah.
which is like the extra stuff on Breath of the Wild or like the extra parts of Hollow Knight. Like that's all digital stuff.
We downloaded two games though,
Yeah, two whole games for sure.
Hollow Knight and Undertale.
Yes. So this company has this value of its stock has gone down. Now, what happened is that there's a lot of people in a thing called hedge funds, and we'll talk about that in a second what they are. They were using short selling to take advantage of the fact that this company was losing value. And some other folks on the internet, they took that personally. And so they got together on a site called Reddit, and
Oh my.
they all got together and around in this area. I'm not sure exactly when it started. They started to all buy, and when you all I have a bunch of people start buying, this number goes way up, and you can see like it goes up really fast.
It's a spike.
Yes, and then so that caused these hedge funds that were short selling to lose a ton of money. And then, so right about here, the details of what exactly happened hasn't all come out yet, but the government may have got involved, or there may have been some behind the scenes collusion. A bunch of the trading apps that people were using to buy stock locked people out of buying more GameStop stock,
Well, that's not cool.
and it caused this big plunge down. And so we'll talk about that. This part of it is still being sort of determined, but like that's what's happening is all of these events are going on, and it made the news because it's a big deal. So let's kind of go over here first. Let's talk about a hedge fund. So we'll say this is my hedge fund.
It's a hedge.
It's a hedge. Good job. So uh, the name hedge probably comes from the practice of hedging which is like safety. So if you ever heard of the phrase hedge your bets or something like
No.
that, all right. So the idea of a hedge is that you're trying to create um, sort of the other side of a bet that you're making so that you are trying to guarantee that you make money or you're trying to eliminate your potential losses.
Cheating.
Well, no, it's not cheating, it's just trying to be safe. So, like,
I was probably thinking of like a game or something.
yeah. So, if we think of something more like, so I want to tell you about sports gambling, even though that's not something you should necessarily do, but it's an example. So let's say we bet on, oh, those are terrible footballs. Some football teams. Two of them play early in the day, and one of them plays late. And we bet on them in this thing called a 3-team parlay. And basically, what that means is that if all three of these teams win, you make lots and lots of money, but you have to have all three of them win. And let's say that early in the day, these two teams both win. So now it's later, this team is playing at night. If I wanted to hedge my bet, one of the things I might do is I might bet on this team's opponent.
Oh.
And so what I'm doing is I'm spending some money, I'm reducing the amount of winnings that I get. So like I could win lots of money with all three of those teams pay out. And so I'm going to bet a little bit more on the other side, and it's going to reduce the amount that I would make if all three of them win, but it's going to guarantee me a little bit if for some reason this doesn't work out. Does that make sense?
Yeah. Well, that seems less like cheating now.
Yeah. So another thing that you might do is, so we have uh, farms that grow wheat and cotton, right?
Yeah.
I don't know if those are very good wheat plants.
They're weird. They're
So wheat is a traded commodity, which means that the price is determined by how much somebody will pay for it. And so since we have a wheat farm, it's good for us when the price is high. That means every bushel of wheat that we grow on those farms, we make more money. Now, there's this other part of it called futures, which is a contract for wheat delivery sort of out in the future. It's for a crop that you don't really have yet. And so, if there's some uncertainty about where this price is going to go, we can use these to make buying and selling agreements sort of out in the future. And what it allows you to do is if the price continues to go up, then of course you make more money. But if for some reason the price takes a downturn, then the futures contract will be more valuable. And so we're going to make a little bit less money with the price going up, but you can let your futures contract help cushion the blow of this price going down. So the futures contract may sort of even it out like this. And so um, it's a way to reduce your risk. Does that make sense?
Yeah.
So that is probably where the name came from. That's not necessarily what they do. So we have our hedge fund.
The pink hedge.
Yes. The primary difference between them and other sorts of investment companies, there's two of them. One is size. So they're huge. They control a lot of assets. Your mother and I, we have different assets invested for our retirement, and a hedge fund would control assets like that. And so that means that instead of investing like $100,000 or even $100 million, they have billions and billions of dollars that they have that they can invest and they can move around. And so that gives them some advantage because of their size, right? The other thing is that hedge funds are legally allowed to do things that normal trading companies can't do. So, one thing is they can use leverage, which basically means they can borrow money to invest in their debts in ways that other companies can't. and they can be involved in these things called short selling. And we talked about short selling once. Do you remember what that is?
Short selling?
Yes.
Sort of.
Try and explain it.
Yeah, I'm not sure.
Okay. So short selling is whenever you're trying to place a bet that the price of a stock is going to go down.
Oh, now I can remember it.
All right. So the way mechanically that it happens is that we have this guy over here. He owns stock, and it's usually, I don't want to say it's a guy, it's usually an institution, like it's a big bank or an institutional trader. And so they own some stock, and our hedge over here wants to short it. And so they're going to borrow this stock. And the way that they borrow is they usually have to pay something back to this guy.
Like a loan?
Yeah, it's like a loan. So it's usually some kind of interest. There may be a fee. They may have to deposit some cash. But basically, this investor that owns the stock is making something from the fact that the hedge fund is borrowing it.
Oh, that makes sense.
They will sell it, and they're going to try and sell it when the price is high. They're going to sell it up here. With the idea, so this agreement over here is that eventually the hedge fund has to pay the stock back. So, like if I gave you 4 Dr. Peppers to go sell at the middle school, right, as a loan, and you gave me a few dollars for that loan, you would sell them with the idea that eventually you're going to give me back 4 Dr. Peppers. It may not be the same one. So if the price of Dr. Pepper is really high, you can sell them and make profit, and then later on when you buy them back, you're buying them back at a cheaper price, and this difference is where you make profit. Okay, does all that make sense?
Yeah, so you sell them at the higher price, so you get a lot more profit, but you buy it back down here when it's cheaper.
That's right. Now, short selling is risky because of a couple of things. One is, we've talked about before, so if I buy a stock, and a lot of times if you buy a stock to own it, it's called being long in a stock. So if I buy a stock, I own a little piece of a company. And that means that even if it goes to zero, in theory, I still own a piece of the company. So if they sell off all the parts and pieces, like the building and the equipment, I might get some money back. Although as like a common stockholder, the chances of you getting very much is low. Or maybe another company comes in and they see, that's supposed to be like buildings and smokestacks and stuff, but they'll see the value, and so they'll buy up that company, and then their stock will convert, and you'll have stock in the new company. And so when you own it, in theory, even if the value goes really, really low, you're still going to get something back. Whenever you short sell, you don't own anything. So if your bet goes bad, you don't have any opportunity to maybe recover some of your losses. The other thing is that there is no cap on your potential losses. So, for example, if I spend $100 to go buy stock in the stock market, how much money can I potentially lose?
$100.
$100. My exposure is always capped at $100. If I'm going to go in on a short sell, if I buy or if I go borrow like 100 shares of stock and they're like at $100, right? So that's like 10,000. Well, what if it goes up and it goes to 200? That's 20,000.
You'll get more money.
Well, no,
You won't?
No, because I'm going to have to buy it back at the higher price.
Oh.
Yeah. And then what if I go ahead and I take the loan out again? I pay the person that I got it from in the first place. We roll the position over and we try again, and it goes up to 300. Now that's 30,000.
You're going to have to pay a lot more.
Yeah, I'm losing money, and theoretically there's no cap to how much money I can lose when I get involved in a short sell. So if the stock keeps going up, then I keep losing money, right? That's what happened in this area over here, right? So once this this started climbing up here, then all of the hedge funds that had short positions in GameStop started losing tons and tons of money because all of a sudden, because they had sold the stock at a higher price beforehand, and all of a sudden they're faced with a position of having to try and buy that stock back at higher and higher and higher prices.
So they already sold it at a high price, and suddenly it just skyrocketed.
Well, yes, they sold it expecting it to go down so that they could buy it back cheaper, and now all of a sudden it's going the other way. So that creates a problem for them. And what happened is two things. So this community on Reddit, they got sort of mad, and for a couple reasons. One is that the stock market is important. It does a lot of very important things for the economy, but it can seem like it's very unfair because if you're not invested in it, then you're not getting a lot of money. It can seem like there's a lot of people who are just sort of engaged in gambling behavior, and a lot of times it feels like the rich people have all of the advantages and poor people have no advantages. And some of that is even written into law. So when I told you before that hedge funds can engage in things that other people can't, so there's actually by law to do to engage in things like short selling and leverage, that hedge funds can only accept what are called accredited, I'm not going to spell out accredited investors, or institutional investors, or well-qualified investors is sometimes the term. And basically that means you have to already be a millionaire if you want to buy into the hedge fund and have them manage your money.
So you have to have a lot of money to be in the hedge fund.
That's right. And so there's lots of different rules, but basically you have to be a millionaire, you have to already own so much stock, or you have to make like $200,000 a year.
So that's like to keep poor people from losing money?
Well, in theory, the law is written up so that only people who understand the extra risk that's involved in these more complicated investments are getting into them, right? Because since you have this money, you're supposed to understand finance better, and you can afford to lose more of it. That's one side. The other side is that because they're able to do a lot of these more complicated things, hedge funds tend to make a lot of money. And so if you were more cynical, you might say that the law is saying that if you're rich, we're going to give you the best tools to stay rich. And if you're poor, then you just kind of have to deal with the stock market with training wheels and stay poor.
But this can kind of make rich people lose money.
Well, so it can because of the risk, but they tend to manage it very well. But so all of these different sentiments, plus some of the specific hedge funds that we're targeting, we're doing two things that people specifically don't like. One of them is called a naked short, and the other is activist short selling. And so a naked short is whenever you engage in a short sale without a guarantee that you have the stocks already borrowed. So we have this guy over here with the stocks that we want to borrow, and our short seller is just going to enter in a bunch of sell orders before they go through the process of borrowing the stock.
That sounds like a great idea.
Well, it can make the market very unstable. It can lead to a lot of what they call failure to deliver, which is a sort of an error, which means that like you can't fulfill your sell orders. A lot of people think that this practice of naked short selling is abusive and that it should probably go away. The other thing that it does is it means that you can put out more sell orders than there are shares of stock that are available. And they were saying that that is one of the things that happened specifically in GameStop. So if we have a fictitious company that has 100 shares, and like that's all that exists, there's only 100 of them in the entire world, and then I say, well, I'm going to sell 150 of them.
That's kind of like going over your credit card number.
Well,
whatever.
So yeah, there's more sell orders for shares than there are shares outstanding, and it can crush sort of the reliability of the market, because that's sort of an impossible thing, and it creates a lot of instability, and it creates a lot of problems. It also puts a ton of pressure on the companies, because whenever other investors know that there's a bunch of shorts out against their company, they're less likely to buy into that company because they see that as negative information. They're going to look at that and say, oh, well, these people, they may have information that I don't want to, or that I don't know, and so I'm going to avoid investing in that stock, and they're sort of forcing it down by putting out all those buy orders. Or I guess they're sell orders. They're putting out a ton of sell orders. The other thing, this activist short selling, is a lot of these places have, of course, all of them have like Twitter accounts. Some of them have newsletters that they put out, or they may have blogs on their website. Sometimes the managers of these hedge funds are guests on TV shows like news and financial news programs, where people go in, they talk about the stock market, they talk about investing, they talk about the economy and how it's doing. And they will use all of those platforms to badmouth the companies that they're shorting.
Clickbait.
Well, it's not just clickbait. They're basically saying, we think this company is going to go down, and so we're going to sell a bunch here to try and buy here at this target, and then we're going to go and we're going to talk bad about the company as much as possible to try and drive it down and make sure that our deal comes through. Right? And
so they sell it here, like at the top, where it's expensive, but then they drive it down on purpose and buy it cheap.
That's right. And so there's a lot of people who look at that practice, and I agree with them. Like that is manipulative, and it's dishonest, and it's kind of cheating. Well, so on this Reddit forum called Wall Street Bets, a bunch of just regular people got together, and they all decided to start buying. And some of them bought to try and make money. Some of them bought just to sort of stick it to the hedge funds that are engaging in these practices. And they started buying here. And around in here is when you started hearing the news, because the hedge funds, by themselves, and perhaps with the help of the government, started doing the equivalent of whenever someone gets mad at the Monopoly game. They flipped over the board and got mad, and sort of left the game. Monopoly board. I misspelled it. But that's okay. Oh, there he is. How Monopoly games usually end up, right?
Usually the end of you win.
Well, that's because I understand chain probabilities and how to assess the value of different properties.
Cool.
So these giant hedge funds essentially did this. They got mad because they were losing a ton of money because regular people were buying into this. And up here, they flipped over the Monopoly board. And how exactly that took place is still under investigation. There's a chance that it may or may not be legal. It would be kind of premature to speculate on it, but one of the apps that they used a lot is this thing called Robinhood, and their symbol's kind of like a little bird feather looking thing. And it's supposed to provide cheap and simple trading. And at this point, when I'm saying people flipped over the Monopoly board, they basically said that if you're in GameStop, there's no more buy orders. You cannot buy anymore. and you can only sell. So what that had the effect of doing is when people can't buy anymore, and this started spreading. It started out here, but it spread out to other different investing and trading companies. Well, if all people can do is sell, if you're not allowed to buy, it's going to drive the price down. Now, those companies have released statements, and there are some regulatory requirements for brokers that are allowing people to buy and sell stock. You have to keep a certain amount of money on deposit to cover those transactions. And there are different rules. Some of them are pretty complicated to try and make the market even and orderly. And so they're saying that those are the reasons why they did it. But this one specific company is connected to a hedge fund that was shorting GameStop. And so it's also possible that their buddies started losing money. And so they called them up and said, hey, you guys need to stop. There are also certain companies that have a financial connection to people in the government. And so it's not out of the possibility that certain government individuals called these different brokers and said, hey, we need you guys to tamp this down. And so
that may or may not have happened.
Well, we don't know, and we may never know the full truth. But there's a lot of people who really feel like the things that happened in this portion of the exercise is illegal, and they filed some lawsuits. They're trying to get senators to do some investigation, and so we'll see sort of how it goes. But that is what happened. And part of the reason this becomes so dangerous for these companies is there's an effect called a short squeeze. And so what happens is, so as these prices start going up, you're potentially losing money with every dollar that it goes up.
Wait, so when it goes up, you lose money?
If you shorted it.
Oh.
Right? Because a short is a bet that it will go down.
Oh.
And so when it starts going up, you're potentially losing a ton of money with every dollar that it goes up.
Oh, yeah.
So the short squeeze effect is because there's three different things in play. And one or two or three of them can be putting extra pressure on you. So one of them is that if you're trying to buy stocks to get out of your short position, like you just want to pay back the person that you borrowed from, then so that's supposed to be volume. It looks like it got a T in there. If everybody's buying and there's not very many people selling, you may not be able to buy enough to get out of it. And so then you're faced with rolling over, or sometimes you'll hear that is a term. They're rolling over their position. They're basically going back to the person. They're going to have to pay more interest, more fees, more whatever it took to open the short position to stay in it long enough to either hope that it goes down again so that they can recover some of their money, or so that they can just buy enough stock to get out, right? Does that make sense?
So they are either going to put more in and hope it goes down eventually, or they're going to try to buy enough to leave?
Well, yes. So they're trying to buy enough to leave, but if there's not enough volume, they can't actually get enough. And so they're having to go back to the person they borrowed from, and they're going to have to basically extend their loan. And it's probably going to cost more money to extend that loan of stock. Does that make sense?
Yeah.
Like, so I loaned you those 4 Dr. Peppers, and if there's no more Dr. Pepper left at school, you come back to me and say, hey, I'm going to need to extend my loan of those Dr. Peppers. I'll probably say, yeah, but you have to pay me a little more interest or a little bit more of a fee, and then so that you can pay me back at a later date. Does that make sense?
Yeah, those kind of sound like a loan.
Yeah. The other thing is that you need to buy to get those stocks back. And what happens when lots of people buy?
Whoa.
The price goes up. So the fact that you're entering buy orders to try and get enough stock to close out your position just drives the price up higher. And
it's making it worse.
It's making it worse. So whenever they get into this situation where all this stuff ramping up, a lot of times, if it's really bad, they'll call it a short squeeze. But that's what's happening is, because you've shorted the stock, that means you need it to go down to make your money. And every dollar that it goes up, you're losing money, and you become trapped in the position because you may not be able to buy enough to get out in the first place because there's not enough people selling. And the fact that you're trying to buy drives the price up even further. So it makes it even harder for you to get out, or it magnifies your losses, and you may be forced to go back to the original borrower and try to extend whatever your agreement is, and that's going to cost you money probably. So you get trapped in this position, and that's why we get this. Flip over the Monopoly table, stop everything, and
just no more.
Yes. So that's kind of what happened. We'll have to see how it turns out. There's still a lot of stuff to go on, but that is why GameStop was in the news. You have any questions?
Whose Monopoly game was this?
I don't know. We usually play the Star Wars Monopoly, so it wasn't ours.
No.
All right. Good job.